Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Triumph New Energy Company Limited annual report. Triumph New Energy Company Limited offers a diverse range of new energy materials and related services. At the forefront of their offerings are various types of photovoltaic glass, including ultra-clear and ultra-thin photovoltaic glass, rolled photovoltaic coated and tempered glass, and rolled photovoltaic glass. The company also provides screen-printed glass, drilled tempered glass, original glass, tempered glass, AR-coated glass, back glass, and double glass component glass. In addition to these products, Triumph New Energy Company Limited offers a range of services related to the manufacturing and sales of new energy materials. Their expertise in research and development enables them to stay at the forefront of innovation in the industry. With a rich history dating back to 1956, the company has established itself as a trusted provider of new energy solutions in Luoyang, China. Triumph New Energy Company Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Triumph New Energy Company Limited trades at a higher price-to-book ratio of 0.61 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various financial metrics. On one hand, the increase in notes receivable and accounts receivable by RMB 243 million and RMB 215 million respectively contributed to revenue growth. Additionally, a decrease in financing receivables by RMB 75 million also had a positive impact on revenue. However, there are several drivers of revenue decline that cannot be ignored. The operating revenue decreased by -29.6% from the previous period, with cash received from sales of goods or rendering of services declining by -44.7%. Furthermore, PRC revenue decreased by 28% and revenue from principal operating activities declined by 28.6%. The impairment losses on credit increased significantly by 2,355.89%, which is a notable driver of revenue decline. Moreover, the oversupply situation in the photovoltaic glass industry led to declining prices and insufficient end-user demand support, further exacerbating the revenue decline. These factors collectively contributed to the overall decline in revenue. Net income and profit margins underwent significant changes over a certain period. Initially, net income decreased from -$780 million to -$969 million, indicating a substantial drop. However, this trend reversed with an increase of 198.5% in net income. The decrease in operating revenue was cited as the reason for this initial decline. Profit margins also experienced fluctuations. Operating profit margin and net income margin both showed slight decreases, from -30.1% to -30% and -17.1% to -18.3%, respectively. On the other hand, non-operating income margin decreased by 63.4%. In contrast, profit before tax margin increased by 9.7%. The reasons behind these changes can be attributed to several factors. The oversupply situation in the photovoltaic glass industry led to declining product selling prices. Furthermore, the narrower cost reduction margin than the decline in product selling prices exacerbated the issue. These factors collectively contributed to the fluctuations in net income and profit margins. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. The data reveals that in both the current and previous periods, there has been a net outflow of cash from operating activities. Specifically, the current period shows a staggering loss of $736 million, while the previous period saw a loss of $394 million. These figures demonstrate a persistent problem with the company's ability to generate sufficient cash from its core operations, raising concerns about its long-term financial sustainability. The company's debt level has undergone significant fluctuations in recent years. Short-term borrowings have seen a notable increase, with a 49.5% rise on page 3 and a 25.7% increase on page 6. However, notes payable have experienced contrasting changes, decreasing by 45.4% on page 3, but increasing by 150% on page 6. Long-term borrowings have also seen growth, with an increase of 16.4% on page 3 and 33.3% on page 6. In terms of interest expenses, there is a notable increase from RM$112,277,461.24 to RM$119,030,051.26 on page 7. Additionally, finance expenses have seen significant growth, with an increase from RM$111,115,163.24 to RM$123.24 on the same page. However, it is worth noting that there are inconsistencies in the changes across different pages, making it challenging to pinpoint a clear trend. Overall, while the company's debt level has experienced fluctuations, interest expenses and finance expenses have seen notable increases, indicating a potential rise in financial obligations for the company. Management is optimistic about the company's future prospects, driven by a shift in industry dynamics towards a more qualitative approach. This change is expected to bring benefits from government policies promoting healthy development. The company will focus on value competition, aligning with national strategies and driving high-quality growth. Key areas of emphasis for 2026 include improving cash flow, reducing costs, enhancing competitiveness, optimizing assets, upgrading product quality, and fostering innovation-driven development. These strategic priorities are designed to position the company for long-term success in a rapidly evolving market. The company's financial performance has been marked by a commitment to shareholder value creation through dividend payments. Specifically, the company has paid dividends in 2 separate instances, with the first payment amounting to $135,093,975.41 RMB, and the second payment totaling $29,365,109.83 RMB. These transactions demonstrate the company's focus on rewarding its shareholders for their investment. There are concerns about inventory buildup or supply chain disruption in the company's operations. The issue is highlighted on page 40, where it is explicitly mentioned as a concern. Furthermore, the significant increase in impairment losses on assets by 2,355.89% on page 42 suggests that there may be issues with inventory management, potentially leading to stockpiling or supply chain disruptions. The prepayments for raw materials and other goods have also seen a substantial decrease of -68.49% on page 50, indicating that these payments are being written off upon receipt of the goods. This could imply that the company is struggling to manage its inventory effectively, resulting in unnecessary expenses and potential losses due to supply chain disruptions. That concludes the financial summary for Triumph New Energy Company Limited. Feel free to comment below, and I will be happy to answer them when possible.